Company tax impacts the living standards of all Australians, because while its legal obligation falls on companies, the economic burden of company tax is ultimately passed on to Australian workers through lower wages. Lower wages imply less income for Australian households and, in turn, lower spending on goods and services. Tax has a significant impact on a company's investment decisions. In other words, a company's decision to buy new buildings, machinery and equipment to produce goods and services crucially depends on the company tax rate. A higher company tax rate reduces the attractiveness of investment, which means that investing in a country with a higher company tax rate, such as Australia, is less attractive than comparative investment in countries with lower tax rates. Less investment by a company would lead to less buildings, machinery and equipment, and ultimately lower production of goods and services, resulting in less output per worker, which means lower productivity, resulting in lower wages for workers, which lowers living standards in Australia. However, a more internationally competitive company tax rate would encourage higher levels of investment in Australia, which would be good for the economy and jobs. But while countries around the world have been reducing their company tax rates in recent years, Australia's has stayed the same. This now means Australia has a relatively high company tax rate compared to some of our nation's competitors. Research shows that our company tax rate is having a larger cost on the economy than most other taxes in Australia, and this has a cost to wages and living standards. This means, for example, a 5 percentage point cut in the company tax rate with a corresponding shift to more efficient taxes could increase our GDP by around 1% over time, approximately a $15 billion boost to the economy.